Stronger US retail sales do little to dent September rate cut hopes. Gold hit a fresh high overnight. New Zealand inflation data is being watched closely for signs of weakness today. Aussie consumer confidence falls, again. And Bank Indonesia looks set to hold rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's Head of Asia Research, Khoon looks ahead to a possible fourth set of Renminbi reforms.
In China's case, they are still quite adamant in managing the exchange rate quite closely, but that hampers the ability of monetary policy to be effective. This is what we call the impossible trinity in international finance.
But first in 5 and 5 with ANZ. US stocks strengthened overnight and Treasury yields were flat after stronger than expected retail sales data failed to dent expectations of a Fed cut in September. In fact, in another sign of growing expectations for cuts, gold hit a fresh record high overnight. The S&P 500 was up 0.4% at 4 a.m. Sydney-Melbourne time. US retail sales were flat in June when a 0.3% fall had been expected. The important control group retail sales rose more than expected by 0.9% in the month. However, ANZ Head of G3 Economics Brian Martin says the 3-month moving average for that is still 0.3%. That's its pre-COVID level.
That, to me, indicates now that consumer demand has largely normalised and under the influence of restrictive monetary policy is likely to normalise further in coming months. I think retail sales data are consistent with inflation returning gradually to target over coming quarters, and I also think the data are consistent with the Fed beginning to start to cut interest rates 25 basis points in September.
The US dollar index was up 0.2% at 4 a.m. Sydney-Melbourne time. That saw the yen slide again through 158 to the US dollar after suspected intervention last week when it went through 160. The Aussie and Kiwi were both down 0.5% at 67.27 US cents and 60.42 US cents respectively. Number 2. New Zealand's second quarter inflation data will be analysed for softness after a series of weak figures raised expectations for Reserve Bank rate cuts this year. ANZ economist Henry Russell is picking headline quarterly CPI inflation of 0.4% and annual inflation of 3.3%. But he says domestic inflation is the key thing to watch. He's looking for that to be about 0.8% in the quarter. That's the same as the RBNZ.
That would signal progress relative to where we have been, but certainly not job done. But in terms of the risks around our pick, certainly if domestic inflation were to surprise to the downside, that would follow 4 consecutive upward surprises on domestic inflation that the Reserve Bank's had since it went on hold in May. And so certainly that would signal that things are starting to turn as indicated by recent business survey data.
Number 3. Strong services inflation in the UK tonight is expected to keep the Bank of England on its toes, risking a later start than August for rate cuts. While annual headline CPI is expected to be near the Bank of England's 2% target, Brian says services inflation looks set to be about 5.6%.
That is too high for comfort. But again, you really need to look into the detail, and the Bank of England is of the view that there could well be some legacy issues holding up service price inflation, i.e. in that some prices are indexed to the recent high inflation that prevailed here in the UK, as indeed it did elsewhere. So I think the Bank of England is increasingly of the view that the backdrop to inflation is improving, the economy is operating below trend, the labour market is weakening.
Number 4. ANZ Roy Morgan consumer confidence measures in Australia fell again last week to 78.5. The second weakest result since December. ANZ economist Maddie Dunk says the expected July pickup from state and federal government cost of living support and tax cuts isn't materialising.
The level of consumer confidence is very, very low right now. So 36 points lower than what we were seeing before the pandemic. And when you ask people how they're feeling about the economy, how they're feeling about their personal finances, we're seeing that they're particularly pessimistic about their personal finances. So those questions are a bit weaker compared to that pre-COVID average. And it reflects the environment we're in, where people are finding that it's tougher to pay those bills. Inflation is squeezing them. High mortgage payments are squeezing them.
Number 5. Bank Indonesia is expected to hold its policy rate at 6.25% today. ANZ economist Crystal Tan says pressure to hike rates has diminished due to downward pressure on the rupiah coming off in recent weeks.
Well, if anything, comments from the governor last week actually showed an easing bias. He recently opined that, there could be scope for a rate cut in the fourth quarter, depending, of course, on the rupiah trajectory. So Bank Indonesia's expectations for the rupiah is for it to trade in the range of between 15,700 to 1600 on average for the rest of the year. So at the minimum, we would need to see the rupiah in this range before it will consider a rate cut. So a key watch point this meeting is actually whether Bank Indonesia will change its outlook for Fed cuts this year.
Crystal Tan there. Now, in our bonus deep dive interview, ANZ's head of Asia research, Khoon says China's desire for more currency reforms could be on the radar following this week's third plenum.
Well, the Chinese economy has continued to evolve and modernize, but its financial sector is still somewhat behind. And what we've noticed is that there is a tendency for China to undertake major exchange rate reforms roughly every decade. The first reform happened in 1994, the second one in 2005, and the last and the third one was in 2015. And interestingly, each of these major reforms happened after the third plenum of that particular period. Now, the timing of it is between 2 to 21 months after the third plenum, so that doesn't necessarily mean there will be an imminent reform. Timing-wise, it's roughly each decade. And the Chinese economy has grown. It's the second largest economy now in the world, and the exchange rate has not really kept pace, I think, with the modern needs of the Chinese economy. And there's greater push by the People's Bank of China to make interest rates as the key monetary policy tool. But it can only be effective if we have a more flexible exchange rate. And really, that's the next phase of reforms that I see that's needed to make the renminbi a lot more market-determined, more flexible, and less managed than it currently is.
So what are the dangers for having a much freer system? For China, at least, where there is much freer movement of capital?
Well, if you start to move your currency to be more market-determined and flexible, that means you have to accommodate greater fluctuations. And there could be times when your currency will weaken more than you would like. That's really par for the course if you want a more flexible floating exchange rate. So in China's case, they are still quite adamant in managing the exchange rate quite closely, but that hampers the ability of monetary policy to be effective. This is what we call the impossible trinity in international finance. So you either manage your currency but give up some independence on your monetary policy, or if you want greater say using interest rates as monetary policy, you have to accept greater fluctuations in the exchange rate.
And what's the need for reform? Is the currency fundamentally out of whack with what's happening on trade? Is it undervalued or overvalued?
Well, in my view, the renminbi at the moment is still undervalued. That's why I don't see any risk of a major one-off depreciation. The renminbi is undervalued because if you look at it from a real effective exchange rate basis, it's actually declined to levels last seen in 2014. Chinese exports remain extremely strong. The Chinese exports are very, very competitive, and it doesn't really need a weaker currency to help it out. So the renminbi weakness at the moment is largely a function of dollar strength and also the wide yield differential between the US and China, plus the weakness in the Japanese yen.
And so, what form could these reforms take, and what sort of time frame are we looking at?
In terms of the time frame, now is probably not a good time to undertake such reforms, given there's still a strong dollar that's putting pressure on the renminbi. But I think in 2025, once the US Federal Reserve is well into its easing cycle, that should see the US dollar come off, and that's probably a more opportune time for the next stage of reforms. In terms of what that could entail, I think providing or giving the market more say in setting the exchange rate would mean shifting the central parity rate or the daily fixing to be more market determined, potentially in line with how other currencies are set, which is based on actual transactions, as opposed to the current method where the fixing is heavily controlled by the PBOC.
Khoon there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, July the 17th. Catch you tomorrow with that New Zealand inflation data and a look ahead to Australia's jobs figures for June. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.